Imagine you're handed a briefcase with $10 million. Now imagine the government standing right next to you, taking $4 million of it before you can even close the lid. That is the 40% estate tax trap. But what if I told you there's a way to move that entire $10 million through an invisible shield, legally, where the IRS can't touch a single penny? Today, we're finishing the buy, borrow, die strategy by showing you exactly how the ultra-wealthy use the wealth shield.
Okay, so let's unpack this for a second. For high net worth individuals, the federal government imposes an estate tax on assets transferred after death. Currently, if your net worth exceeds the exemption limit, which is $13.99 million for an individual in 2025, every single dollar above that threshold can be taxed at rates up to 40%. That is just a massive, massive wealth erosion event. So to stop this natural dissipation of wealth, estate planners use this invisible shield to literally rewrite the rules of ownership.
Section 1. The 40% tax trap and the invisible shield.
So, let's look at exactly how this shield is constructed, because it fundamentally alters the way wealth is held and transferred. The core weapon in this wealth defense arsenal is the irrevocable trust, and you really want to notice the word irrevocable there. When you set this up, it becomes a completely separate legal entity with its own tax ID number. As the creator or the grantor, you completely surrender direct ownership and control. You can't just change your mind later, alter the terms, or take the assets back. But by giving up that direct ownership, you gain virtual invincibility. The assets are removed from your taxable estate, shielded from future creditors, and in some states, they're even protected from divorce and bankruptcy.
Section 2. Dynasty trusts and forever wealth.
Historically, great fortunes would just dissipate over a few generations through estate taxes, gift taxes, and the generation-skipping transfer tax. But dynasty trusts, they stop that process dead in its tracks. By allocating your generation-skipping tax exemption to the trust right when it's funded, those assets, and all of their future growth, which is huge, can move to your children, your grandchildren, and your great-grandchildren without ever being subject to wealth transfer taxes again. It systematically bypasses the tax system generation after generation.
And this brings us to where these trusts actually live. You might be wondering, why on earth do billionaires flock to places like South Dakota? Well, it's because states like South Dakota have engaged in a literal race to create the ultimate wealth haven. They repealed what's called the rule against perpetuities, which is basically this ancient legal doctrine that used to force trusts to eventually end. Now, trusts there can last forever. Add in zero state income tax, zero capital gains tax, and perfectly sealed public records, and you have a high-tech vault where family fortunes can privately grow, completely obscured from the public eye.
So the absolutely crucial point here is understanding the math behind this forever timeline. According to wealth planners, an initial $1 million investment placed inside a dynasty trust, compounding at a conservative 6% after-tax growth rate, would be worth an astonishing $39 trillion after 300 years. Let that sink in. By shielding assets from a 40% haircut every single generation, the power of compound interest operates completely uninterrupted.
Section 3. GRATs, or freezing your assets.
Now, this next strategy is specifically designed for assets you expect to grow very, very rapidly. A GRAT, which stands for Grantor Retained Annuity Trust, acts almost like cryogenic freezing for your estate value. Here is the mechanic. You transfer an asset into a short-term irrevocable trust. The trust then pays you back an annuity over the term, essentially returning your original asset value plus a really minimal IRS-mandated interest rate. But here is the absolute magic of it. Any growth of that asset above that modest IRS rate passes directly to your beneficiaries completely tax-free. It doesn't even count against your lifetime gift tax exemption.
Think about it like this. What happens if your startup stock suddenly explodes in value? Let's say you put $1 million of pre-IPO shares into a GRAT. The stock goes public, and the value rockets to $10 million. Because you froze the initial value, the trust just returns your $1 million plus a little bit of interest. But that explosive $9 million windfall, it goes straight to your kids. The IRS only ever sees the frozen original value, completely missing the massive appreciation. It's brilliant.
Section 4. Slats, eyelets, and strategic shields.
Okay, giving up assets sounds great for the long term, right? But what if you still want access while you're alive? Or you just know you'll need cash to pay final expenses? Well, we have two incredibly strategic tools for this. First is the SLAT, or Spousal Lifetime Access Trust. This is where one spouse creates an irrevocable trust for the other. It gets the assets totally out of your taxable estate, but because your spouse is the beneficiary, your household still maintains indirect access to distributions for health, education, maintenance, and support. Then we have the ILIT, the Irrevocable Life Insurance Trust. Its sole job is just to hold life insurance. This ensures the massive death benefit doesn't accidentally inflate your estate, providing pure, untaxed cash right when your heirs need it most.
Let's walk through the actual flow of an ILIT because it's super elegant. As the grantor, you gift cash into the trust. The trustee then uses that cash to purchase the life insurance policy. When you eventually pass away, the ILIT collects the proceeds. And because you had no incidence of ownership, meaning you couldn't borrow against it or change the terms yourself, the IRS literally cannot tax it. The trust then uses that tax-free cash to either purchase assets from your estate, which gives your estate the liquidity to pay any remaining tax bills, or it distributes the cash directly to your beneficiaries. It is just the ultimate clean liquidity strategy.
Section 5. Building generational stability and the pivot.
All right, so we've looked at the billionaire master plan, but how can the ambitious viewer, you, legally and ethically apply these exact principles today to start building your own foundation? Because honestly, you don't need $100 million to start thinking like the ultra-wealthy. Step 1 is simply separating legal ownership from beneficial enjoyment. Start looking into basic trust to pull high-growth assets out of your immediate taxable name. Step 2, leverage life insurance early. An ILIT is incredibly powerful even for upper-middle-class estates, just to ensure your heirs aren't forced to sell off family assets simply to pay taxes. And Step 3, plan for the long game. We have to stop thinking in terms of just our own retirement and start thinking in terms of a true multi-generational legacy.
This quote right here really captures the essence of this entire explainer. Generational wealth isn't just about what you earn, it's about what you relentlessly protect. Earning is only half the battle. The other half is ensuring that your life's work isn't just dissipated through poor planning, a lack of legal structure, or the totally predictable cycle with taxation. We've seen exactly how the wealthiest families on Earth rewrite the rules of ownership to build literal fortresses around their assets. They use irreversible structures to freeze growth, generate pure tax-free liquidity, and build legacies that can last for centuries. The tools are out there, and the rules are written right into the tax code for anyone willing to learn them. So the final question I have to leave you with today is this: what will your invisible shield protect? Thanks for joining me on this explainer, and keep building.